What is up, YouTube? This is The Working Investor. In this video, we're going to talk about the performance of VOO, which is the S&P 500 from Vanguard, SPYI, which is a cover call from NEOS on the S&P 500. We're going to compare it to YMAX from YieldMax, which is the fund of funds, YMAG, which is the Magnificent Seven cover call strategy, which they have against their ULTY, which I think is a complete dog so far. And we're going to talk about risk-adjusted return, Sharpe ratios, and how to, if you do hold these funds, how you can hedge against it to make sure that your overall portfolio value stays equal and balanced and doesn't get hit as hard. Nothing here is financial advice, tax advice, legal advice, or any form of advice. This is for fun and entertainment purposes. Only see all my disclaimers and take your own risk. Let's get into the video. So obviously, as you guys were seeing over here, that this SPYI is down just like the S&P 500, but you notice that SPYI from NEOS, they're down a little bit less. They're subtly less down. That's because they also write cover calls on their underlying, and they're generating premium. So they go down with the market, but they also have the delta of having premium. YMAX is down 5.67%. YMAG is down 10.88% because the Magnificent Seven entails NVIDIA, which they have NVIDIA in YieldMax, and they also entails Tesla, which they have Tesla, and they've been hit hard. So hence YMAG has been down pretty hard, and two-fifths of their, two portions of the 7 portions of the portfolio is down hard. And ULTY, which is supposed to be a whole entire hedge fund, and they do all kinds of crazy acrobats and nonsense. Whatever they're doing, it's still not working because they suck. They're down 8.2%. Yes, the market is down. We can even look back and we can look at, people argue and say, look at October 15th, 2024, when they changed the prospectus, they're still dog doo-doo. Because look at it, ULTY, 0.66 is their total return. So having from the change of their prospectus until today, you barely made anything. And barely making anything is actually losing money because 3 things. You got to pay taxes. If you want to argue that it's ROC, return on capital, and it's a non-taxable distribution, you're also losing money because of inflation. Because inflation, I'm sure things got more expensive since October 2024 until March 2025. And opportunity costs. Why on earth are you investing money just to have the same amount of money? You could have put your money into SGov. You know what I mean? You would have done better in SGov than ULTY. So it's a complete dog. If you go back 1 year, it's rubbish. I know people argue October 15, but look, until they prove themselves, they're in the doghouse. So if you go to the 1 year chart, you see VOO 12.13%, SPYI underperformed a little bit, well, because they have capped upside, because they do cover calls. YMAX only 4.06%, which is disappointing. And I have to rethink what I'm going to do with YMAX, or if anything. And YMAG, at least they have 12.03%, and they kind of matched VOO over the 1 year chart. But in the past quarter, they've really went down. And the ULTY we already spoke about. Let's talk about something called the Sharpe ratio. I'm not here to go too academic in this. The Sharpe ratio is basically something that gives you a number, and the number lets you know about something called risk-adjusted return. For every unit of risk, because every time we invest in the market, we are taking risks, and we want to have a fair return for the risk we take, right? So are you getting a fair bang for your buck, right, when you put your money out there? So the way to read it is less than 1 is considered bad, though a lot of things are less than 1. But the closer you get to 1, the better. 1 is adequate. 1 to 2 is adequate. When you go to 2 to 3, it's very good. 3 or higher, it's excellent. And the S&P 500 is about 0.9 or somewhere in that range, close to 1, 0.9, high 0.8 to 0.9. And I went on ChatGPT, and you can see here VOO has a Sharpe ratio of 0.86. NEOS, the SPYI, has a Sharpe ratio of 0.96, which is better because they derive extra income, so they have a better risk-adjusted return. So even when the market's down, they should be able to have a little bit of a damper. Should doesn't mean they would. YMAG is 0.69. Again, everything I say here is not financial advice, tax advice, legal advice. If I didn't say it before, Please use your own risk and see all my disclaimers. This is for fun entertainment purposes only. YMAX and ULTY, they didn't really have much data. I kind of pressed hard to give me some YMAX Sharpe ratio. So they kind of pulled out Portfolio Labs, which they use for the other ones. So I'm going to go with that. They say it's a 0.37. I mean, you see other ones are all over the place. 1.8, negative 5.4. So let's just say 0.37 for argument's sake, because it's the same source. So they're saying that YMAX may be a less of a risk-adjusted return. I always thought otherwise, but I need to rethink what's going on. So I went on Portfolio Visualizer. I'm going to show you some hedges. Not all of them I put in here because they don't have at least 10 years worth of data. And some of them are like proxy hedges because I have hedges that are newer that are derived from these. So this gives me some idea. So this is called correlation coefficient. And some things that are correlated, you know, one is perfectly correlated, negative one is perfectly inverse, right? So I'm looking for things that are at least like closer to zero. Zero means there's pretty much no correlation. I'm trying to find funds that have even a slight negative correlation, and still perform well in itself. And it's hard for me to find some of them. So I found funds that are positively correlated, but very mild. So for example, gold, GLD, and we're going to focus on gold against the VOO and the QQQ, because a lot of the funds are S&P and, you know, NASDAQ tech related. And you'll see that it's a low correlation coefficient to the S&P and a low correlation to the NASDAQ. And if you look at Berkshire Hathaway Group B, Warren Buffett's, you know, fund, you could see that it's moderate. It is correlated to the S&P, but 0.74. And it's actually looks like here, you know, maybe a better hedge against the Qs because it says it's a 0.57 correlation coefficient. And then let me show you on Seeking Alpha and some other hedges that I have. So let's get rid of ULTY because it's a dog in my books and I can only put 7 things in here. So let's put in here GLD as you guys kind of hinted out. You guys saw my hint. Let's talk about BRK as well, as you guys saw earlier. And let's also add CTA as well. Right, so CTRA is basically managed futures through SPYI, and we need to go into in depth what that is. It takes a whole video. So if you look at the year to date, you can see when the market has been down the past quarter, you have assets that are uncorrelated, but you see they go up. Some of them go up. So you know the VOO, SPY, YMAX, YMAG, ULTY, as you know, is down year to date. Gold was up 14.91% year to date. You know, so they kind of could keep your portfolio a little bit. It's a little stabilizing agent. You know what I mean? Possibly. Berkshire Hathaway Group B from Warren Buffett, 17.63%. CTA, managed futures, up 4.77%. Now look at this. If you go to the one year chart, you could see CTA is up 22%, 22.3%. It pretty much almost doubled the VOO in the past year. In the 1 year chart. Berkshire Hathaway Group B, 29%, also more than double the S&P. Gold, triple the S&P 500 in the past year over year. So you could see that how these things, they do have positive drift in themselves, and they do sometimes outperform, not always. If you go to the 5 year chart, VOO is up 134%. SPYI, I don't think it's been around for 5 years. So YMAX has not been around for 5 years. YMAG has not been around for 5 years. So let's ignore those because we don't have the data for 5 years. But gold, you know, so 134 versus GLD, which is 81%. So decent, and you see some years it outperforms. Gold it's just a precious metal commodity, doesn't have any earnings or anything. It's just kind of like an inflationary hedge, but it's, I wouldn't say, again, to have a lot of it, but just to have a little bit in the portfolio could seem like a little bit of a damper. Look at Berkshire Hathaway Group B. They obliterated the S&P 500, right? CTA, right? Not too bad. Well, again, that's also been out not too long ago. Right, so I can't really say. Were they out for 3 years? Let me see. CTA, they're out for 3 years. Yeah, I think. Yeah. So CTA has been around. So basically, these are some ideas of basically hedging the portfolio. They do not. I think CTA does give a quarterly dividend, but Gold doesn't give dividends. But you could do options on it to kind of make some. You could do cover calls a little bit. You don't want to cap too much of your upside because it defeats the purpose of the hedge. Berkshire Hathaway, you could do some options on them if you wanted to. They're a little bit expensive. Group B, even Group B is like in the $500 range. But there are other stuff that could hedge out the portfolio. Now, they're hedging it out because they don't have capped upside if you don't put cover calls, or you could control how far you want to put them out of the money. But you want to make sure you have a lot of runway on the upside, because you want to complement all your capped upside, and you want to have uncorrelated assets with positive drift. That's what I'm thinking about. Anyways, I hope you guys enjoy it. Let me know what you guys think. What are you guys using as a hedge for a lot of these risky funds that we have to kind of keep your portfolio even? This is the Work Investor Overnight. Have a wonderful trading week.